Mary Buffett, Buffettology, the previously unexplained techniques that have made Warren Buffett the world's most famous investor. Embark on a journey to discover the secrets behind Warren Buffett's incredible success as an investor. In this summary of A Buffettology by Mary Buffett, you will explore the unexplained techniques that have made him the world's most famous investor. Learn about Benjamin Graham's influence on Buffett's investment strategy, the concept of being businesslike in investing, and the importance of consumer monopolies. Grasp how to evaluate stock based on earnings per share and why the price you pay for a stock is critical for your returns. Get ready to find your own consumer monopoly and expand your circle of competence.
The businesslike mindset of investing. An essential part of Warren Buffett's investment strategy, influenced by his mentor Benjamin Graham, is thinking about stocks as actual businesses rather than speculative lottery tickets. This businesslike approach involves analyzing a company's potential profitability, calculated risks, and long-term growth. This methodical and often more lucrative tactic contrasts with the rapid returns sought by many on Wall Street, focusing on slow but steady growth over time. When it comes to investing, Warren Buffett's great mentor Benjamin Graham taught him one critical lesson: the most intelligent investments are also the most businesslike. But what does it mean to be businesslike in the investment arena? To treat stock buying as a business means to think of each purchase as becoming a part owner in that company, as opposed to merely acquiring a lottery ticket with unpredictable outcomes. This mindset requires analyzing the stability and profitability of the company, along with the potential risks involved. For example, if you were thinking of buying a drugstore, you would evaluate the company's consistent profitability, consider possible changes to the market, such as the emergence of a challenger, or determine if its products would maintain demand. Additionally, calculate the expected annual return on your investment. For instance, if a drugstore was priced at $100,000 and its average yearly earnings were $20,000, that would equate to a 20% annual return. Comparing this with other opportunities would allow you to determine the best possible investment. Another crucial aspect of treating investments as businesses is adopting a long-term perspective. Unlike many Wall Street players who chase swift returns, Warren Buffett is known to hold on to a stock for an extended period. Many investors prefer instant returns, like a 35% gain on investment, rather than a compounded 20% growth over several decades. However, this pursuit of rapid gains often leads to a higher capital gains tax, reducing their return significantly. For example, a 35% return could be cut down to 25% after taxes. Furthermore, frequent reinvesting can expose investors to riskier ventures as they continually shift their money. Investing the Warren Buffett way prioritizes high, predictable returns over a long-term perspective. This businesslike approach is not only more consistent but often proves to be the winning strategy in the world of investments. Unveiling consumer monopolies. Warren Buffett has consistently found success in investing in consumer monopolies, businesses that dominate their industry without the need for continuous investments in physical assets. Their stronghold is driven by consumer goodwill arising from factors such as superior products, effective advertising, and convenience. Buffett's strategy focuses on identifying these monopolies that have a strong competitive advantage, earning them significant profits and sustainable growth in the long term. Throughout Warren Buffett's investment journey, he has been remarkably successful in identifying extraordinary businesses and sticking with them for the long term. This strategy has rewarded him handsomely with investments in companies such as Coca-Cola, Hershey's, and Bank of America. His success stems not from luck, but from spotting businesses characterized as consumer monopolies. So, what exactly is a consumer monopoly? Think of it as a toll bridge. When people need to cross a river and have no other choice, they use the bridge, giving the toll collectors a monopoly on river crossings. Buffett evaluates a company's potential as a consumer monopoly by asking whether he could feasibly compete with the business and take away its market share. In the case of Coca-Cola or the Wall Street Journal, the answer is no, thanks to their strong competitive edge. This competitive advantage is driven by a concept known as consumer goodwill, which Johns Hopkins University student Lawrence N. Bloomberg introduced in his 1938 dissertation. Goodwill emerges from a combination of factors: a superior product, convenience, courteous employees, excellent advertising, and sometimes even a secret ingredient. Businesses like Coca-Cola and the Wall Street Journal are prime examples of robust consumer monopolies. Another characteristic of consumer monopolies is their ability to produce goods or services without heavy reliance on continuous investments in land, manufacturing plants, or equipment. This allows them to avoid high property taxes and maintenance costs, ultimately leading to higher profits. Examples include Coca-Cola and Marlboro cigarettes, both of which require minimal updates once their factories are built. In contrast, companies that need ongoing massive investments in physical assets, such as General Motors, experience hefty costs and lower profit margins. Their constant need for expansion through new manufacturing plants and equipment prevents them from achieving total market dominance. In essence, if you want to invest like Warren Buffett, direct your focus toward consumer monopolies for long-term success. Unveiling consumer monopoly secrets. The best investments lie in consumer monopolies, enterprises that effortlessly amass profits. 3 distinct types of consumer monopolies can be identified through Warren Buffett's investment portfolio: businesses producing short-lived products, communications businesses, and repetitive consumer services providers. Examples of these monopolies include Coca-Cola, media networks, and firms such as ServiceMaster or H&R Block, respectively. Diving into the realm of strategic investing, consumer monopolies stand out as the most appealing ventures. Often acting like profit-generating toll bridges, they demand attention. By examining Warren Buffett's investment choices, we can unveil 3 categories of consumer monopolies that have proven successful. The first category contains businesses producing rapidly consumed or perishable products. These companies typically boast significant brand recognition, compelling merchants to carry their products or risk losing business. One shining example of such a company is Coca-Cola. With its seemingly unbeatable popularity, practically every reputable drinking establishment feels compelled to serve it. The second category features communications businesses, which play a vital role in product advertising. These businesses, including TV networks and advertising agencies, provide essential channels for manufacturers to showcase their products to consumers. With advertising being a constant necessity, manufacturers become reliant on the communications companies, making them a secure investment. Last but not least, the third category highlights businesses providing repetitive consumer services consistently in demand. These businesses often rely on low-skilled, non-unionized temporary workers, resulting in reduced expenses and increased profits. Prominent examples are ServiceMaster, offering cleaning and pest control services, and H&R Block, providing tax assistance. With minimal capital expenditure, these firms keep profits flowing generously. In a nutshell, identifying and investing in consumer monopolies offers excellent potential for significant returns. By understanding the categories of such businesses, investors can emulate the portfolio of the iconic Warren Buffett and potentially reap their own financial success. Earnings per share, Buffett's unorthodox view. Earnings per share is a crucial factor in stock evaluations, but Warren Buffett's unconventional perspective on earnings has set him apart from other investors. With an emphasis on trust in company management, Buffett prefers businesses that retain earnings and reinvest them well, leading to long-term capital growth, a tactic exemplified by his own company, Berkshire Hathaway. Master investor Warren Buffett has a unique approach to understanding company earnings. Typically, investors assess a stock through evaluating its earnings per share, EPS. These reveal a company's profitability by dividing its earnings by the number of outstanding shares. For instance, a company with $7.6 billion earnings and 3.98 billion shares has an EPS of $1.91. If this number rises, it's generally a positive sign as it indicates increasing profits. However, the average investor usually doesn't see these earnings as their own unless they are paid out in dividends. Buffett, known for his unorthodox methods, views the earnings as his personal property based on the number of shares he owns. He believes that the earnings of the corporation in which he invests are his, proportional to his shares. For example, if he owns 100 shares of a company with $5 EPS, he would consider having earned himself $500. Buffett's perspective is that earnings can be either retained and reinvested profitably, or dispersed as dividends. In either case, the shareholder should benefit. Because of this belief, Buffett pays close attention to the management's handling of earnings, an aspect other serious investors should also consider. In contrast to the majority of Wall Street investors, Buffett desires companies that retain earnings rather than distributing them as dividends. This is because, when dividends are paid, capital gains tax is applied, reducing investor profit. Alternatively, businesses that reinvest earnings profitably can boost their company's underlying value, which is then mirrored in the stock price. This allows investors to hold a stock that increases in value over an extended period. Buffett's own multinational holding company, Berkshire Hathaway, exemplifies this strategy. In the early 1980s, its shares traded at $500. Today, they are worth over $400,000 per share. The key to this success stems from Buffett's tactic of reinvesting retained earnings to enhance the company's value. Berkshire Hathaway has never paid a single dividend. Considering that earnings are essential to investments, it's crucial to trust the management of the company. If a company retains its earnings, investors must examine whether it reinvests them productively or frivolously. Poor management of earnings is a strong indicator to avoid investing in that stock. The price-return connection. Warren Buffett emphasizes the importance of buying stocks at the right price. The price you pay for a stock determines your potential rate of return. By analyzing a company's earnings per share, EPS, you can make informed predictions about future earnings, enabling you to buy stocks at the right price for optimal returns. Following this approach can help you consistently make sound investment decisions. In the world of investing, the price you pay for a stock is critical. This might seem like common sense, but many investors often overlook this, buying shares at any price and merely hoping for an increase in value. This is speculative behavior, not genuine investing. To invest successfully like Warren Buffett, you need to buy the right stock at the right price. The significance of stock price lies in its direct impact on your potential rate of return. For instance, if you pay $100 for a stock with per share earnings of $20, you'll achieve a 20% rate of return. However, paying $200 for the same stock results in a 10% return. Simply put, the higher the price, the lower the return, and the lower the price, the higher the return. To make smart investment decisions, you must purchase a stock whose price aligns with your desired rate of return. In order to determine this rate, you'll need to accurately predict the company's future earnings. This can be done by analyzing historical data regarding the company's earnings per share, EPS. Buffett demonstrated this approach when he invested in General Foods in 1979. By examining the company's EPS growth, a steady 8.7%, he was able to reasonably predict that earnings would grow to $5.05 per share. Buffett purchased 4 million shares at $37 each, achieving an initial rate of return of 13.6%. Ultimately, his conservative predictions were exceeded when General Foods' EPS reached $5.12. Paying attention to both stock price and EPS is essential when choosing investments with high, consistent returns. Understanding and implementing this connection is the key to informed, successful investing. Unleash your investment potential. Every investor has a circle of competence, areas where their knowledge and expertise lie. Just like Warren Buffett, it's crucial to recognize and focus on these areas when considering an investment. To begin with, turn your attention to companies that provide products or services you're familiar with or use daily. Determine whether these corporations have a consumer monopoly, growing earnings per share, and reliable management. Accessing financial information is easier than ever, as many companies' websites offer annual reports and resources like ValueLine and Moody's provide crucial financial data. It is also essential to dig deeper into the company's management to understand their approach, trustworthiness, and competency. If you can zero in on a company that meets these criteria, you might have uncovered an exceptional investment opportunity that even Warren Buffett would be proud of. Are you set to take the plunge?
In conclusion, the book summary of Buffettology reveals the essential principles that have guided Warren Buffett to become the successful investor he is today. By focusing on being businesslike in investing, selecting consumer monopolies, and considering the price paid for a stock, you too can enjoy consistent returns on your investments. Always remember the importance of understanding the company, its management, and their approach to retained earnings. By following these simple yet effective principles, you'll be well on your way to achieving the same level of success as the legendary Warren Buffett.